Everyone can hear me?
Hi.
Yes, you are audible.
Everybody,
thank you.
We can get started. Thank you so much. Sorry about that. Okay. Good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is February the 15th, mid-Feb already. Happy Valentine's to everyone yesterday. In case you missed it, I'm delighted today to be joined by three of our regular guests, Ms. Vibhuti Garg, Director of South Asia for the IEEFA, Mariha Bengali, founder of MB Commodity Corner, and Professor Andre Bellier, founder and CEO of Ballesen. So thanks so much for joining us, everybody, on this Wednesday morning. Not such a dynamic week in markets as we have had perhaps in the last few weeks. Mariha, let me start with you and look at sort of macro outlook impact, if you like, on what we're seeing out there. We had a couple of important figures that came out yesterday in terms of inflation, etc. What's the current mood, if you like, now for markets? We had a bit of a sort of hiatus, positive vibe in January across equities, for example. Current sort of projections, if you like, as we go sort of end the first quarter and into Q2 for macro and how that's impacting sentiment, if you like.
Thank you very much. Yes, you're right. The CPI yesterday came in a little bit hotter than expected at 6.4%. So on the surface, it looked a bit hawkish and the market was actually dipping on that. But if you look at much more in the detail, the core services ex shelter, the preferred Fed measure was actually slowing down a bit. So the market took that, initially rallied on that. The market is a bit of a two-way pull right now because they pretty much expect another 25 basis points by March, and then the Fed is done. The market is sort of trading as though the Fed really is done. There's a bit two schools of thought on that, because if you look at the data deeply, price pressures still remain quite high. So there are some macro traders who think the dollar actually is not done with its rally and the Fed may have some more work to do. It's a big debate in the market whether the Fed can move from a pausing cycle to cutting and pivoting, but the market's trading as though they're already pivoting. And you can see this rally in tech shares and long duration assets. And it's almost like they think the recession has a soft landing. We don't agree with that. Our view is that this is going to be a lot longer and protracted than expected. Rates higher for longer. We have never been in an economic environment where rates have stayed close to 5% and asset classes have not suffered. So but right now the market wants to trade on a very short bias where everybody's uninvested and they want to chase the rally higher. But the Fed has been very adamant. Their work is not done. You're still talking about inflation close to 6%. They say they need to get core services ex shelter down to 2%. So the dollar is sort of very confused on back with that backdrop.
And I mean, you're saying they want to get, do you still believe that they are looking to sort of get that 2%? I mean, a lot of people are saying, as you said, oh, we've already started to slow down inflation, fantastic. We're not there yet, but 2% really, I mean, they're going to have to do a lot more rates to get there, and that's dangerous for everything else. So that seems to be the sort of counter argument, if you like.
Right now, the Fed is sort of very happy that their work is actually doing a good job. For instance, we raised about 475 basis points in 1 year. We've never raised rates so aggressively any time in history, but the market's not broken. The labor market's still tight. So the Fed is like, right, something's actually working, but there's a bit of a lagged effect. Payroll data is going to get very ugly in the second half of this year. So the street is actually being quite complacent, because if you look at the economics J curve, it's never happened that you'd have this sort of unemployment market. Even the Fed can't explain as to why it's so tight, but I think there's a lagged effect and the economy is in a much worse shape than people expect. So the equity market is actually looking past this by saying, oh, the Fed will support us, but the macro markets like bonds, rates, and credit, they're quite distressed. So there's a bit of a disconnect. And I think you're right. The market is probably getting a bit too complacent as to this being a soft landing.
Okay, well, I'll come back to you. I'd like to talk about bonds and where that sort of market's now come back in, if you like, popular again as an alternative. Having been sort of decimated really for the last year or so. Vibhuti, welcome. Good morning again. Great to have you. Let's talk a bit about Asia and Asian demand and how that's buoying or not oil markets and oil prices in terms of forecast for that. India, of course, being one of those main consumers, and the Indian economy seems to be sort of exceeding all expectations and way ahead of other economies at the moment, including China.
Hi, good morning. Yes, you're right that India is witnessing very high exponential economic growth and as a result, very high energy demand growth as well. And this growth story is going to continue. So while COVID-19 and the Russia-Ukraine war did had some short-term disruption, but in the long term, the fundamentals are very, very strong. And given India is now emphasizing a lot on boosting domestic manufacturing in India, in order to alleviate, the concern of energy security, because we have been importing not only oil to meet our energy needs, even for renewable energy sector, a lot of our modules and cells were being imported from China primarily. But now there is an increasing focus on boosting domestic manufacturing, not only to meet its own demand, but also looking at increasingly for meeting exports and meeting demands of other countries as well. So that is going to drive a lot of economic growth in India. And moreover, there's a lot of urbanization as well happening in the country, that there is an increasing income propensity, which is leading to higher demand as well. So there are a couple of drivers which are leading to this growth story. And as a result, there will be definitely an increase in demand for all kind of fuels to meet its economic growth. Yes.
Okay, and I'll come back to that actual demand in terms of where it's getting its energy. And you mentioned it's been diversifying as well beyond oil. Professor Andre, thanks for joining us again. Great to see you again. And Happy New Year. I haven't seen you personally on the show since then. Good to see you. Let's talk about, I mean, of course, you're not in Russia, but let's talk about Eastern markets, and let's talk about, the Ukraine war, but specifically this announcement by Russia last week, the unilateral announcement that it will be cutting its output. It didn't have too much impact on the market, but the big question seems to be whether, why they did that. Did you have any insight from why you think they would have made that statement when the markets, for all intents and purposes, is expecting its output to be decreased anyway? So why did it come out and say that, do you think?
Thank you, and Happy New Year as well. Well, yes, Russia decided to cut the output, partly in response to the import embargo, which is taking place. On one hand, is a political step, so it's a political stance to kind of pressure the markets on the topic. So somehow, if you, let's say, the logic is like, if you are blocking us, we're gonna push the prices higher and create a deficit in the market. At the same time, we have to understand that with the embargo, it became indeed way more difficult to export oil and oil products, and therefore the oil cut is also motivated by, let's say, this rationale. And finally of all, I think we have discussed it last year, the effect of sanctions on, especially on large oil companies in Russia, and state-owned company Rosneft and other large companies, is pretty heavy, because they are facing restrictions for getting credits for new field developments. They have a number of restrictions for technological access to technologies, and it's quite interesting to see that over the last year, small regional companies such as Tatneft had a boost in production, whereas other companies, bigger companies, rather had a slow decline. In rates.
So let's talk about that decline. I mean, did you see that in general, the sanctions having more of an impact on the domestic production? Like last year, a lot of people said, well, we didn't see a change in Russian production anyway, it just changed in flows. Are we actually going to see production impacted this year, really, in that sense, in terms of parts, access to what it needs to keep its output up?
The thing is that most of the information since last year, most of the data is now classified by the Russian Federation, by the government, which basically is signal that things do not work properly. And at the same time, we shall not easily trust the data that is actually coming out mostly from the Russian mass media, basically. To say that there are heavy sanctions. No, there are no major effect from sanctions. There are no short-term effect, at least not on the policies that Russia conducts towards Ukraine or towards Europe, but the midterm effect is there, but we cannot assess it since most of the data is classified.
I guess we'll wait and see where the Russian oil reaches and how much of it. Maliha, just back to you on oil prices, which are to an extent, being impacted by expectations on how much oil Russia will produce as well as everybody else, and how much oil will be out there. Projections at the moment, we had a bit of a sort of boring static oil price range the last few weeks. I mean, yes, we had a couple of blips up and down, but they seem to be settling in this range. Is that the sort of sentiment right now? What will tip it up or down from this level?
You're right, actually. Oil price has been very, very stable in the first quarter this year. Usually in winter, you see a bit of surprises on the demand side, supply side. So the street is a bit, I think, bullish on this market right now. They're a bit disappointed because they expect oil to go up to 90 or 100, 200. But I think the key thing here is that, even though everyone is very excited about China reopening, China has come back. The flights are back to 90% of pre-COVID levels, but yet the demand across the world is a bit weak. So we are pricing the positive China, but EU and US demand has been weakening, and that's why product inventories are rising. So I think that's sort of coupling with the market that's very flat to boring. Now, having said that, once we enter and exit this winter season, you can argue as to what demand will be second half of this year. But if you look at across the board, people are still very bullish oil and very confused as to why the oil price is actually not rallying. And the oil equities actually are sort of rallying on back of the yield. So it's a very interesting place, but I think people are a bit long and holding, thinking oil can only go up. Oil could be boring for 6 or 7 months because you have so many different factors. Last year, inventories were very low across the board. We've actually compensated for that, and now inventories are building. Even gasoline cracks and diesel cracks are falling down. And the world's a bit shocked as to why prices are falling. So it may be boring, and people have this view that OPEC would always be there to support the price sub $80. They're happy with it right now. But I think we can't discount how weak everything else on the demand side is. And I think that's something that's surprising a lot of people right now.
Yeah, and I mean, as you said, this sort of, no recession is expected anymore, maybe in the US, but certainly the ripple effect of the inflationary measures perhaps has not yet been felt. Just to stick with you, Maliha, for now, you talked about China demand, China's back, but actually a lot of people are saying that demand really hasn't kicked in yet. We're going to maybe see it in the second quarter. It's going to take longer than it's going to take longer than what people have certainly been showing so far in terms of the positive impact of that on oil.
You're right, because China did a very good job in stocking all the inventories before the war, and last year their onshore inventories are quite high. So even though the demand has come back, a lot of the local inventories are being used for that. And yes, they've obviously taken oil from Russia as well. But that demand surge, my logic has always been that if China takes oil from Russia, it means it has less OPEC barrels. So it's just being rerouted. There's not a magic number of 2 million extra demand coming from China. And if you look at all the numbers, and I've gone through all the sell side numbers, they're assuming a massive demand rebound of 1.5 to 2 million barrels per day. Where is that coming from? So people are expecting a deficit for the second half of this year, assuming those numbers, but the first half of this year is showing a surplus of oil right now. So you need to really look at the whole situation dynamically, but you are right. China's been very smart about how they restock ahead of this pre-COVID strategy to reopen to the world. And that demand pickup has not really resulted in prices going higher.
Okay, Vibhuti, I wanted just to ask you, going back to the Indian economy, which, by all intents and purposes is doing fairly well compared to the rest of the world. Energy demand, as you said, will continue to go up. Let me ask you a bit about its intake of Russian crude. That was a big factor last year. It became, I think it was taking almost 20% or more of its oil imports were coming from Russia by the end of the year. What's the outlook this year? Is it as confident that it can get the Russian crude it needs? It got very used to those discounted prices.
Yes, you're right. I mean, the share of Russian imports was as low as 2% at the start of last year, and now it's about 28%. So and they are one of the largest now exporters of oil to India. So the share has gone up tremendously, and I think given that we are experiencing very high demand, the Russian oil imports are continuing. We are going to see a continuation of the similar kind of trends this year as well. But at the same time, the Indian government is pushing for more sustainable energy choices. So they are pushing for biofuels. So they, a week back, Mr. Prime Minister Modi did announce a biofuel policy, which will be kind of, it's been announced like ethanol blending to the extent of 20% to be achieved by the year 2025. And that's how it's trying to reduce its import of oil. So there are some strategies that the Indian government is also thinking, whether it's pushing for electric vehicles. So electric mobility is something, but it's going to take time. But in the near term, I think the approach is to blend ethanol as much as we can. So already, I think to the extent of 5% is being done, but raising that 5% to 20% by 2025 is something that the Indian government is aggressively looking at. So which might reduce our oil demand to some extent. But in 2023, I don't see a lot changing.
Okay, and I mean, India, presuming and assuming Russia, let's say, cannot supply as much because of restrictions on its own end, India, you'd say, would be happy with this $80 plus oil that's floating and being sold to other buyers who don't have access to Russian crude?
Difficult to comment, but I mean, I can speak.
Will it do more switching to coal? Will it do more switching to other fuels, or is it happy with 80 now that it's, everything is very positive? So
no, it means that we did witness very high inflation. It's only now in January this year that India has been able to control inflation, which was in double digits for almost for a lot of months. Now it's the WPI is hovering in the range of 4.5%, but retail inflation is still over the comfortable 6% mark. So definitely the idea would be to get prices lower. And when the prices went lower, I think the Indian government strategy was to increase more revenue by increasing more taxes. So they didn't pass on the benefits of lower oil prices to the consumer. So it didn't impacted the consumer sentiment so much. But in the last 1 year, it did mean an increased subsidy burden for the government or losses for the OEMs, who were supplying this, because while India allowed prices to be market linked, but in the last couple of months, they did not allow the OEMs to increase prices. So that remained stable throughout.
Of course, and the subsidies are a big part of it. It's fun, of course, and to keeping that and keeping everything calm. And I wanted to talk to you a bit about Pakistan, India's neighbor, which has the opposite case of how well its economy is doing. Andre, back to you. Let's talk a bit about the Ukraine war, the Russia-Ukraine war. Again, stalemate, escalation. It's oscillating between the two. Of course, we had the president of Ukraine recently in Europe. Talking about more support, asking for more support, etc. I want to ask you about an article we had today on our news headlines, which is the China-Iran visit, the visit by President Raisi to China yesterday, talks of bilateral relations, etc. What impact do you think that is having on Russia's thinking in terms of the geopolitical triangle, if you like, of continued tacit support from Iran and from China for what's happening in Europe? I mean, is there anything that Russia should read into yesterday's visit between the two countries?
Yeah, I cannot really comment on this because it's very difficult to, to guess what is in other people's mind. What is important to observe is that China kind of created a certain level of support to Russia by rejecting, let's say, various pressures from the West on imposing the sanctions. But at the same time, China was a disappointment for Kremlin, for sure, because they didn't help Russia either. And China has its own agenda, and it's difficult for me to identify what is this agenda. Obviously, they are happy to have leverage in negotiations with Russia over oil and gas imports. You see that actually, for example, Russia was in a very weak position in negotiating the power of Siberia 2 with China. Also, there have been some discounts for oil sales. And at the same time, China didn't allow some of the Russian operators to use China to escape the sanctions. So it is a tricky position, I would say.
Yeah, keeping its neutral stance and China first, really, policy. Maliha, to go to you, I wanted to talk to you about the bonds markets as well. What, can you explain? There's been a bit of a sort of more positive vibe there to an extent in terms of money going into bonds, whether it's corporate or sort of government debt. What's the direction of travel for that in terms of sentiment, given what we've seen on equities and given the whole macro policy of the Fed?
So in terms of the US bond market, you're right. Last year has been a very anomalous year where both equities and bonds were down about 20%, right? So a lot of money flowed out. But this year, bonds are actually quite supportive because if you look at the market right now, searching for yield, US 10-year bond yields are close to 4% right now. They're sort of oscillating between 3.5% to 4%. There is a bit of pressure on the rates being higher. For the curve is still very inverted on the 2-year, 10-year, in the many trajectory. So that sort of signifies there's a lot of stress in terms of the recession outlook. The Fed may have a policy error, but in terms of direct flows, the market actually likes bonds here because the risk reward looks very tempting. People are investing in equities right now that give you anything above 4% yield. And I think bonds will look very supportive because eventually when something does happen and we have a recession, bonds usually are a very good asset class to be invested in. So investment grade credit bonds, high yield bonds, US 10-year bonds are looking very attractive and then flows are very supportive. On a short-term basis, you could get a bit of a hiccup in terms of inflation overshooting, but in terms of a long-term, I think we feel bonds are still a lot more attractive than equities right now, given the recession risk scenario.
And I mean, do you think that, we talked in your initial comments about, Fed policy direction and that the market has been underestimating how it's going to continue. But is the current sort of sentiment that it will really not push rates much beyond 5%? It may keep them there for a long time, but is there that sentiment that it's just too risky if it goes above that?
You're absolutely right. Right now, the market is very comfortable with the terminal rate of 5%, maximum 5.2%. And they're assuming that basically, given the way the economy is right now, we're going to magically sort of revive into the end of the year. And eventually, when the labor market does slow down, inflation will actually cool off. The Fed will have a lot more room to cut rates. Historically, going back to my career, the last 25 years, I've never seen a market where you have 5% rates and such a tight debt environment and something does not snap. So that's a very big, I'm having conversations with people on both sides, but in my view, it's even higher for long, which the market's talking about how they're pricing it in. Things have never been. Go back to 2006 and 2007. We had the same situation for a year. And then we had Lehman's and AIG and all sorts of collapses. We have never been in a period of time where there's been $30 trillion in national debt, 5% interest rate, mortgage markets collapsing. And yet you say the market will have a soft landing. So you are right. I think everybody's talking about this higher for longer, but I don't think they understand what it means to digest what it means for higher for longer is a very restrictive policy. It is hard to grow. So it's a big debate right now.
Yeah, and of course we've got the earnings that have been coming in for the fourth quarter, and now it's the big question is how, where's that filter going to really reach in Q1 earnings next quarter when we see those come out. There's our poll question for today. Do you expect Russia to announce more unilateral cuts this year on sanctions? As sanctions, bite further. So we had the unilateral cut, and we'll see what happens next. There's our question. Hold on a minute. I've just got the yes or no. There we go. So we had a commentator on the other day who said that this first announcement may be one thing, but nobody really knows what's in its agenda. Is it just a one-off, or is it going to be continuous sort of policy throughout this year? I suppose people will be watching that very closely. Vibhuti, back to you. Let's talk a bit about the region as well. And Pakistan, next door to India, has of course had a very different economic story from every angle in terms of how its economy is doing. To the extent where the pressure is now so high that there is social unrest. That triggers that could get much worse. Would that be your point of view? It's negotiating a deal with the IMF at the moment. what is the outlook for the Pakistani economy, and does that reverberate at all into India in any way?
No, I think both the economies are quite isolated, so it won't impact. I mean, there was a lot of trade that used to happen, but over the years it has gone down. So, but if you will look, I mean, everybody is watching out what's happening in your neighboring countries. So Sri Lanka faced this crisis last year. Pakistan is undergoing very similar crisis. And even if you look at Bangladesh, I mean, in the last couple of months alone, they have raised their electricity prices twice or thrice, and is again putting a lot of burden on the consumers. And one of the big reasons for the failure of, or the economy is going down is huge reliance on fuel imports because of their declining foreign exchange reserve, because they're not being able to now buy fuel at such high prices, and that's kind of impacting their economic growth as well. Yesterday only Pakistan announced that they're gonna cut LNG imports, and they're gonna look again to meet the demand to domestic coal. But you have to realize that domestic coal will take time first to mine, and then start producing electricity from coal-based power generation. So it's a long time that this whole thing can kick in. It won't be like overnight that they'll be able to address the demand needs. I think clean energy, I don't understand, even including India needs to accelerate its renewable energy deployment, because that can happen within a short span of 12 to 18 months. And most of the countries in the South Asia have huge renewable energy potential. I think that's where the focus should be. And clearly,
that will require a lot of investment, obviously, and particularly in Pakistan's case, it doesn't have the cash, and all the more reason why it needs this IMF deal to rescue it on all fronts. Thanks, Vibhuti. I'll go back to you now. Andre, can we talk a bit about gas? Vibhuti just mentioned LNG. Let's talk about Europe gas. It got away with it this year by some efficiency measures, obviously, but also warm winter, etc. And we see gas prices now pretty low compared to where we saw them last year. Many people, though, saying we're up for another peak this year again. Where do you see that from Europe's point of view? How comfortable can it be about gas reserves, gas stocks, and the outlook on the year ahead for that?
Yeah, well, it is very premature to make significant, let's say, projections for a number of reasons. First of all, the withdrawal season is still continuing, and the injection into underground storages will start in May. So far, it is difficult to project what's going to be with underground storages. Likewise, it will be difficult, or it remains difficult to project what will happen with Russian supplies. Yes, the European Union is happy having actually mitigated major elements, let's say, of the crisis. Didn't allow itself plunging into a gas deficit, but there were basically three factors which helped. First is that demand of LNG in Asia, particularly in China, declined, which allowed some, let's say, additional volumes of LNG to be on the market for the European Union. Second of all, yes, the winter was warmer than average, and that also helped to somehow keep the underground storages with filled. And finally, still about 60 to 70 BCM were supplied by pipe from Russia.
And what if Russia doesn't? Gas.
I didn't finish. So what if the Russian supplies are really halted forever? Yeah, entirely. What if LNG supplies are insufficient? And finally, what if the what if the demand in China goes back? And basically, we don't know answers to those questions. The only thing that we have observed is that, in average, across the European Union, gas demand declined for about 20%. In some regions, like where I am, for example, it declined for 40%. So let's say the fuel switch will certainly be there.
Yeah, it will happen again, and certainly there are a lot of people talking about that all coinciding by the summer, which is China demand will be back fully on track, and Russian gas will have been fully switched off, and therefore we could certainly see a spike in prices. We had the survey answer up there earlier, which is that yes, it's the expectation is that Russia will unilaterally cut again, but again it may have to anyway, but certainly use that as political ammunition. Thank you so much. We've run out of time, I'm afraid. Thank you so much for joining us, Maliha Bengali, Vibhuti Garg, and Andre Belli. Thanks so much for joining us this morning. All the best.
Thank you very much.
Thank you.
Thank you.
Thank you very much.